Hello, everybody, and welcome to the Dorsey Wright podcast for Wednesday, March the 18th, 2020. My name is Jay Gragnani. On the line, we have Ben Jones, Steve Raymond, and Ian Saunders all joining us for the podcast this week. And there's certainly not a lack of things to discuss in the market. Most notably is the elevated amounts of volatility as a result of the increased uncertainty around the market between the coronavirus, oil wars, and the likes. And to put some of this into perspective for many, the volatility that we've seen so far this year and so far over the past month has been unlike very few other market environments that we've seen. It's hard to believe that we're sitting here talking about just 1 month ago. Tomorrow, February 19th, the S&P 500 hit a new all-time high. And today, March 18th, we are seemingly on track for the 13th consecutive day that the market has been up or down 1% or more, and seemingly the 8th consecutive day that the market has been up or down 4% or more. And that amount of volatility, we've got to go back many years, many different market environments, years such as 2008 and even all the way back into the 1929 crash to see periods like that we've seen in the market. So certainly an unprecedented time in terms of speed and velocity that this correction has occurred now. And so, one thing that we wanted to do is provide a little bit of perspective in terms of what has changed with respect to indicators, but also taking a look at where things are with respect to just general support levels on market indexes like the S&P 500.
Yeah, when you're looking at the S&P 500 right now, and this is looking at a 50-point chart, you could just see that high that you were talking about, Jay, right? That 3,350 level, that was at peak, just really a few weeks ago. Of course, since then, we've seen the S&P 500, correct down all the way to its, early January 2019 lows. But there is some constructive support. We do see support that, goes down to that December 2018 correction low. That's that 2350 level. And then, of course, you have the, long-term bullish support line right around that 2200, 2250. So there is some support, and it's important support, right? We're talking, that's where the market bottomed in a previous correction, certainly one that, wasn't as swift, but, as you kind of are in the middle of that storm, it certainly, felt bad. So right now we're looking at that 2350 as your December low. So that's what we see with the long-term chart of the S&P 100, Jay. We do see extremely oversold levels. If you look at the S&P 500 right now, at least as of the close of yesterday, you're still over 170% oversold, which is extremely rare. If you're looking at average readings, for the average stocks within some of these universes, they're at the most oversold levels that I think we've ever really tracked, right? Blowing out through their October 2008 lows, going through, even some of like the 2003 correction lows. So it's a very oversold market, to say the least, Jay.
Yeah, that's a good point, Ben. And in other words, a good practice is to take charts that are important to you. And I often think of none more important than the S&P 500. It's kind of the center of the core centric thinking, where you're looking at the bigger stocks and you're looking at the higher quality stocks around the world. There's no more higher quality market than the U.S. market, and the centerpiece to that would be the S&P 500. So to kind of mention what Ben mentioned is to zoom out a little bit. When you see a chart, maybe a default chart that you see on our site, maybe it's short term. There's a lot of action, so sometimes it's much more helpful to zoom out and get a bigger picture on where things are. A 50-point chart on the S&P makes a lot of sense, where you can see some time pass and you can get to see your different support levels, kind of assess where you are, assess where the trend lines are. And I think that can give you, some comfort of knowing where the market is and looking at the different places around there. Keep in mind that, a lot of strategies are pegged knowingly or unknowingly to the S&P. A vast amount of mutual funds that will be in 401ks, many models that different purveyors would talk about. Of course, Dorsey Wright, it has a fair amount of various models, but certainly have models that are core centric, meaning that rely on the S&P, to function well. And by understanding one S&P chart and by being able to follow that gives you kind of that helpful aid to the game plan of, hey, where's the market? Where are the trend lines? Where's the support levels? Because, this is something that we'll, continue to stay on top of, and it can give you kind of if you will, a map, to the different action points that will be very important, including, the important upside action points, So, on both sides of the equation, where are we on the next offensive upside action points on a big important index? Where are we with possibly negative further support level or breakdowns on the roadmap? And I think it would be very helpful if everyone started looking at that chart and kept up with that.
Yeah, that's great. And when we think about looking at that S&P chart, certainly, very, very important to monitor going forward. The other thing that we look at quite a bit is in terms of the markets and kind of taking the tact of what has changed. One of the big changes that we've seen really this month and continue to see unfold over the past week has been change within our asset class ranking system, change within our DALI, if you will, dynamic asset level investing. And for really the first time in almost 4 years, since August of 2016, U.S. equities had been ranked number one. And at the beginning of March, we saw that fall out. We saw U.S. equities fall out of that number one spot. And over the course of the past couple of weeks, we've seen U.S. equities continue to fall in its ranking. International in equities as well has fallen all the way down to number 6. U.S. equities is now at number 4. And so we're looking at a DALI ranking today that looks very, very different than it did a month ago, even a few weeks ago, where fixed income is ranked number 1, cash is ranked number 2, and currency is ranked number 3. So if we think about the construct of DALI and we think about the 6 asset classes, it's really broken down into 3 asset classes that would be viewed as more risk-on growth type of areas, that being U.S. equities, commodities, and international equities. And then 3 being more lower beta, more defensive type of areas like fixed income, like cash, and like currency. And so today what we see is an environment and a picture within DALI that has all 3 low beta defensive asset classes in the top half and the 3 growth asset classes in the bottom half. And the question becomes, when was the last time that happened? And we have to go back to the 08-09 time period since the last time that we saw that really happen. And very specifically, in August of 2008, we saw that configuration, not in the exact same order, but we saw fixed income, cash, and currency ranked in the top 3 asset classes. It happened in August of 2008 briefly, and then again reverted back on September 10th specifically. September 10th, we saw currency was number 1, fixed income was number 2, cash was number 3 based on those rankings back then. And that persisted until mid-December of 2008. And what's interesting about that, if we say, okay, that time period, September of 2008, I mean, you were almost a year removed from the all-time high back in October of 2007 versus today, you're about 1 month removed from the all-time high. It was also September of 2008 was also the month at which Lehman declared bankruptcy. And leading up to that, so on September 10th of 2008, when we saw Dolly see the top three asset classes in the lower beta things, the market was down about 21% from the October 2007 peak. So it took about a year to get to that point. From September 10th through December 16th, which was the period that domestic equities, international equities, and commodities were in the bottom half, and the three lower beta things were in the top half. So for that 3-month stretch, the market fell another 25%. Market rallied a bit in December of 08 into January, and then once again in January 14th, we saw fixed income, cash, currency, all back in the top 3 positions once again, and that persisted until March 23rd. And so, when we go back and we think about just kind of in terms of rankings, you go back to those time periods to see, those are the last couple of time periods where we saw the type of configuration that we're looking at with respect to those Dolly asset class rankings today. And they were, relatively short-lived, but they still, for a 2 to 3 month stretch there, the market certainly still had a bit more volatility.
Yeah, you're absolutely right. I mean, if you look at the ranking right now, it's defensive, right? See the risk off assets, and with currencies moving up there, it's almost like a cash proxy, right? With the U.S. dollar, kind of leading, our currency rankings. Anyone who's listening and looking for some currency ideas, ways to kind of be defensive, take advantage of this kind of play, you can come to the website and you can explore these different links. They'll give you a list of ETF ideas or fund ideas for kind of currency exposure. But right now, it's predominantly being led by defensive currencies, which the market is viewing as the U.S. dollar. You've seen a little bit of momentum in the franc and a little bit of momentum in the yen. But right now, kind of looking at the rankings, it's almost like a cash proxy. So, I mean, what do you think, Steve, kind of looking at this complexion of Dolly and what's favored? Any interesting comments there?
Yeah, I think that, stepping back, with the evidence of how, Dolly's responded, Dolly responds to actual market fabric. In other words, the data that we use in our mechanisms is reading what the market's doing. And this move of equities moving down some ranks in Dolly into a particular configuration, as JG pointed out, 2008 is a good roadmap of when that occurred. It just seems that getting into that configuration means that we just have to continue to play that ball that they pitched. And it also tends, the data leans to suggest that this will unfold over months, not days. In other words, it will take time. It's more of a protracted path through that we need to be prepared to walk through. Another way to say that would be, maybe this won't go away overnight. To get these asset classes back into what you could call a classic bullish configuration with equities on top, may take longer and move through different market. The market needs to find, its path, and getting the equities to start climbing back up is what we're looking for. But the data leans that we need to, practice patience as well, and realize that, it may take some time, to get back on, a footing that people were used to or comfortable with. No different than 2007 in the conversion into 2008, where there was a game plan in force in 2007. It just so happened in that era, we did a lot of non-U.S. There was some non-U.S. leadership that had been going on for years, and different leaders, small caps and so forth. And then we convert into 2008 kind of landscape where again the relative changes, and we start to follow that guidance. The models gear over to pick up that and maybe spend some time working on that kind of game plan, and then down the road it will lead to another market alignment of assets. Is kind of that's kind of what Dolly's saying. Hey, we need to begin to pay attention to the asset class shiftings, and that keep going down the road with it. Dolly's unlikely to obviously change the alignment of asset classes tomorrow. Obviously, it's going to take some time. I thought I'd just make that comment.
Steve, I think that a point you mentioned there, that is the Dolly tool is going to be is reactive to movement in the market, but not necessarily something that we see move around all that much. But it is there. I think, and the important point you mentioned there, it is going to be reactive to those significant moves. I mean, the movement that we saw following Monday with the almost 12% decline of the S&P being one of the larger declines that we've seen over the past several years, that led to the domestic equities falling, and that fell by 44 signals, which was the single largest drop for the asset class going back to 2005. We also saw international equities last week fall 63 signals, which was its largest single day drop in the Dolly rankings going back throughout the history of the tool. So while I think it is an important thing to keep in mind too for all of y'all out there, that the significant moves that we're seeing going on in the market are leading to some changes. And as Steve mentioned, those changes are at least historically not undone quite easily.
Yeah, good point, Ian. So maybe to recap is that this will take time to unfold, and as the asset classes change, that gives us information, and we keep adapting that into the game plan. And of course, models do follow underlying data and indicator changes, and we're right in the in some case in the middle of that flow. And as you those of you clients that have been fortunate to be with Dorsey Wright through 2008, do remember that we have various models to follow, and then there are indicators to continue to watch, because knowing where you are is very important. Where is this market? Of course, we're judging that daily, weekly, monthly. Where is the market, and then how do we translate that to advice to our clients of when are those modes of time where we need to preserve more wealth, and then when are those important times where we need to get geared up for wealth accumulation? And they're going to come. Each offensive period is met with a defensive period. Each defensive period ends with a conversion back to offense. And I think it's important to use the tool set, to use the information from different segments within Dorsey Wright, as well as other purveyors outside Dorsey Wright, to make sure you're always armed with what we're doing now, leading to hey, what we will be doing when those action points hit in the future. This is the point that like I said, some years are easier. I think JG and I had a podcast saying 2017 was quite an easy year to go through, a kind of a cruising, let the market will glide with the market. And then 2008 as an example was a working year. We have to work, we have to step through, we have to stay on top of things, handhold clients, your clients, you're helping them through this very stressful time. I just want to point out, we also are here to help the advisor who also, may want help, to go through these times. But this year, 2020, looks like it's going to be a working year. We're not gliding, we're working, and the advisor's working to get from this step to the next step. It reminds me that there is no one step. Right now, there's no action you could do per se today that makes all the difference in the world. I think it's more of being there, throughout the year, saying that we're going to step through these important changes as they occur. I might also mention, we don't necessarily want to prognosticate. We want to just say, what is the case? And today, what is the case? Okay, let me absorb that. Let's take a step. Tomorrow and next week and next month, kind of the same mindset, to make sure that we don't lose touch with the market, and again, get to work helping the retail clients step through these rougher waters, and then have the game plan. And I'll just conclude that small paragraph with, Dorsey Wright has several model types, many indicators, and many of you financial advisors that you are part of this culture. We're part of your culture. There's many things to help us keep in step with what the market's telling us to do, and take advantage of the opportunities that it provides.
So Jay, what are the indicators saying right now? Have we seen any changes? What's their field position?
Yeah, I think it's interesting when you look at a number of indicators. One of our primary being the Bullish Percent chart, so the New York Stock Exchange Bullish Percent indicator is one that is defensive. It's been defensive, reversed down back in January 31st after that market, and has consistently declined all the way now back into single digits. So we're reversed down at 58%, steadily marched down the field over the past couple of months, and is now at 6% on its Bullish Percent chart, which is the lowest reading that we've seen, spoiler alert here, since 2008. And that's been a common theme amongst lots of things that we're seeing about this market, is there are things that we haven't seen since that 2008 time period. Now, it's not to say that this is exactly like 2008. It's just to say that the market activity has reacted in many ways like 2008. Obviously, 2008 was financial crisis during that time period. This time we've got coronavirus and oil. So just different things going on, but nonetheless, we're seeing things that we haven't seen in 11 years, since going back to when the bull market started, March of 2009. And so when you look at the Bullish Percent chart today, in a column of those, still defensive, yet very, very oversold in what would be considered to be washed out levels, because this is just the fifth time since going back to 1974 that we've seen the Bullish Percent reading down in single digits. And just remember, when we talk about Bullish Percent, the Bullish Percent is simply measuring the percent of stocks within that respective universe that are trading on point and figure buy signals on their individual charts. So if there's 100 stocks that we're looking at, and 50 of those stocks charts are on buy signals, 50 are on sell signals, and this indicator would be at 50%. So what this is telling us today is that 6%, only 6% of the stocks on the New York Stock Exchange, of which there's somewhere in the we call it 2,500 level, only 6% of those are trading on point and figure buy signals on those charts. Saying that another way, 94% are on sell signals or being controlled by supply. And so supply remains in control of the vast majority of individual stocks out there when we look at it from this perspective. The other times that we've seen this indicator below 10% or in the single digits, last time was March of 09, and when it dipped down to, November of 08, when it dipped down to 8%, fell to 8%, ultimately reversing up. Prior to that was October of 2008, when it fell down to 4% and then reversed up. And that, going back to that kind of 09 bottoming process, and it was a process. In October of 2008, the indexes hit new lows, the Bullish Percent hit new lows at 4%. Stocks rallied a little bit into early November, mid-November, they pulled back. And the S&P 500, the market indexes at that time, actually made new lows. They took out their October 2008 lows, but the Bullish Percent reversed up from a higher level, falling down to 8%. Now, what that was telling us was that fewer stocks were participating in that fall to new lows. It was the bigger cap stocks that were driving the indexes to new lows, while individual stocks were not as many were participating. Again, you saw a rally in December and January, then a pullback February, March of 2009. And once again, the indexes, the S&P 500, they all fell to new lows in March of 2009, ultimately hitting a bottom March 9th of 2009. Meanwhile, the NYSE bullish percent chart was reversing up in March of 2009, making yet another higher bottom as even fewer stocks were driving the market down to new lows. And so that's just some of the interesting perspective and observations that you can get when looking at these bullish percent charts. Because, you know, in 08, 09, that market bottom, it wasn't an event, it wasn't a specific day, it was a process. And so that is certainly something that we'll continue to watch and monitor going forward about this market to see, you know, where these indicators bottom and ultimately looking for signs of bottom. So for those of you who are looking for signs of a near-term bottom being put in, one of the things that you can do is watch for a reversal up on this chart. A reversal up on this chart is going to indicate to us that there is now, for the first time in over a month, an indication that there's net new demand coming back into the market. So if you see a reversal up on this bullish percent chart, it means that we're seeing individual stocks go from being on sell signals to being on buy signals, which would be indicative of net new demand coming off of the sidelines and moving back into the market. Real quickly, just on this, I mentioned 5 times, two in 2008, that October 08, November 08 time period. The other times that it fell into single digits was following the crash of October of 1987, and then in September of 1974 is when you got down there. And so that 74 time period was pretty interesting. You fell down to 8%, and you know, certainly coming on the heels of the 1973 oil crisis, oil embargoes going on there. So you know, certainly some similarities that can be gleaned from that. But nonetheless, as we're looking for evidence or at least early warning signs of a near-term bottom being put in, this is a great chart to watch for that.
I just wanted to point out that JG's right, that the 2008 market was really defined by a lack of strength in the large caps. I'll give you a for instance. When we all as brokers walk into the office on January 3rd of 2008, the S&P 500 is already at the bottom of the asset class group scores. In other words, the S&P is already, the large caps, if you will, is already flatlining on a gurney somewhere before we start the year. Still plenty of things to do that year for the first half of the year, mostly things and sectors and small caps and non-US and so forth. This is very different so far now. We've been in a high core dominance, meaning large cap controlled market. The S&P 500 still has a percentile rank at 62%. You know, its high dominance was 96 or so, but earlier in the couple month period here. So we're still to blend this with the context that JG mentioned in watching the bullish percents. You know, we're still, you know, quite hopeful that the larger caps are still the stronger set to pay close attention to on reversals up in the bullish percent, as opposed to necessarily the small caps. In other words, we're still large cap, you know, dominant. Again, those readings could change, but they're certainly holding in there now. You know, kind of as the place to, you know, look at first. When indicators, you know, kind of have washed out and begin to reversal up.
You're absolutely spot on. And, you know, we have seen some reversals already, right? And so I think that's something to expect when we're at these low field positions, is just volatility and, you know, potential choppiness. So some of the smaller universes, right, which are going to be more sensitive and, you know, can change a little bit quicker, you know, did respond to some of the positive movement we saw yesterday. A lot of that is just that the way that these charts are reversing up and down, they kind of reverse up, reverse back down, and, you know, there's a lower top that they're able to kind of get past and move to a buy signal. So we did see the bullish percent for the S&P 500 reverse up. Again, you're still at washed out oversold levels. This is, you know, not necessarily a sign to buy by any means, but, you know, you are seeing a little bit of participation. But this could, you know, like we see in previous years, and just go up and down and up and down. So we need to see confirmation, and confirmation is when we start to see this kind of form a higher bottom like we saw in previous years, or maybe move to a bull confirmed status, which is, you know, column of X's exceeds the previous column of X's. The good news is, you know, team, is that, you know, some of the research that, you know, kind of the analysts and, you know, some others in Dorsey Wright have done, we typically, see, kind of a high volatility state at these low levels, which to be expect. But going out, a few months from now, you tend to see kind of positive returns for the market as it finds a bottom. Some of the work that John Lewis has done, looking at the New York Stock Exchange bullish percent and the high low, is when they get washed out, you tend to see, positive forward, 9-month and 12-month returns. So, I think as we are looking for that light at the end of the tunnel, I think, that's something to think about. But again, we need to see confirmation. We need to see these indicators reverse up. And anyone listening, you can access some of this data in the daily equity report that we published on Monday. You can also look at the webinar that Jay, Chuck, and John participated in. We had the recording. But some of the work that Steve and Jay and Chuck have done to kind of look at these indicators provide a I think confidence of kind of where we are and what to look out for. And I had earlier Steve and Jay and Ian highlighted kind of the alert function. Jay, you mentioned definitely you want to look for a reversal up, and I know that everyone has a lot going on and they're making trades and adjusting the portfolios and talking to clients. And I think I say this in every podcast or video, but let the system work for you. Feel free to pull up an indicator and set an alert. So if it reverses up in the X's, you'll be notified by email that, hey, we're beginning to see some changes. So that's something to keep in mind.
And another point on that as well, when we're looking at allowing the system to do some of the work for you, another way to do that through the system is obviously going to be there through the models tool. And with the relative strength changes we've seen in Dolly and across other indicators and stuff on the platform over the past couple of weeks, there's obviously been a fair amount of rotation in several of the models that we have there. So we've tried to keep up with those in the report, whether it's the weekly ETF reports or in the daily report. But obviously, if you all have any questions on any of the particular model changes there, or maybe why one hasn't changed, more than welcome to reach out to us there. The analyst team is always going to be available there during normal business hours over the phone or by email.
And let me add an old adage. Don't anticipate the anticipators. Actually allow the indicators to give the guidance that we've mentioned today, because it's when important bullish percents or other indicators that we could point to, or that we'll talk about over the next weeks. It's when they're at the lowest level. You could say that last 10 yards to get across the finish line is to a very low level, is when the market's at its highest volatility. So the lowest field position is attractive from a future offensive point of view, but it's also where occurs the highest market volatility, which again, you could consider the most dangerous part of trying to pick where the bottom is. So anticipating the anticipators would mean you're trying to get in there and preempt where you think an indicator will bottom out in low field position. But that's actually, you need to be cautious with that thought process and actually let the indicator, reverse up, do the healing. In some cases, short-term indicators may take, a couple tries at it, out of low field position. So you just want to be aware that the lowest field position is also the highest volatility, and let the indicators, as was mentioned before, let them filter through that high volatility to give us a good signal to participate with.
Yeah, spot on, Steve. And so other tools to look at, I know many of you listening kind of engage in sector rotation and certainly following the models. But I think now's a good time to kind of look at just any changes that we see going forward. As the market potentially searches for a bottom. A great way to kind of get a visual graphic would be any of the distribution curves available. If you're trying to kind of make sense of how oversold everything is. We have the favored sector, spectrum tool, gives you an idea of, how sectors are doing and the participation that we're seeing there. As you can see, most of the sectors are in this bottom half of this graphic, and they're at washed out levels. You can see only a few sectors are even above 10% on their bullish percents, and that's electric utility is a very defensive sector, waste management a very defensive sector, food and beverage. It is interesting. We did see banks kind of move into X's, but still low field position, but really nothing material there. So some clients are asking kind of, hey, how do I know when we find a bottom? Where do I look to see if we see some improvement on a sector level? This is just one of those tools. As you begin to see sectors reverse up in X's and then migrate from unfavored to average, that means they're gaining some strength. So this is one of those many tools that we have on our site to provide kind of a picture of where we are and kind of what's happening in different corners of the market. So just something I want to bring to the table there.
Yeah, that's great, Ben. And it's so interesting. You look at so many of those bullish percent charts down there in the single digits, and just kind of indicative of this market environment that we've been in. It hasn't been confined to one or two sectors. It really has been, really has been across the board. And so, staying on top of that, setting the alerts are certainly going to be things to watch going forward. And if you're so inclined, is building a shopping list. So that the question is where, if you want to look to buy and why some of these things reverse up, is where do you want to go redeploy that capital? Using some of the tools like the security screener on the website and searching for some of those stocks in whether it be specific sectors, whether it be specific inventories, focusing on those strong attribute names. And the favored sectors are going to be a great place to find some ideas when looking to redeploy some of the capital. So with that said, certainly not a lack of things that are going on in the market, not a lack of things to pay attention to in the market. And that's what, we're certainly focused on in these contexts of podcasts that we do weekly. We produce content daily through our daily equity and market report as other videos. So that's kind of where we're squarely focused on in looking at the markets. With that said, we are also obviously very, very focused on what's going on in the world around us with the coronavirus numbers continuing to increase, and certainly here in the U.S. continuing to see new cases pop up all the time. So we're certainly aware of that. As a result of that, we have NASDAQ has instituted a policy that we are working remotely from our respective homes, but we are still functional. We're here for you to the extent that you want to have a phone call. We're here. Our phones are open. Our emails are open, and we're on top of things. So with that said, we certainly hope everybody stays safe and healthy out there, and appreciate you tuning into us this week, and look forward to talking to you next week.